How I underwrite deals conservatively to protect capital. Anyone can make a spreadsheet look good, but experienced investors know the deal lives or dies in the underwriting. That is why our approach at Ellison Capital is very conservative and disciplined and built to withstand market shifts, because protecting investors' capital is non-negotiable, especially when you're dealing with six-figure investments. Hey, welcome back to the series. My name is Shade, a multifamily investor based in Calgary, Alberta. And today I'm going to walk you through how we at Ellison Capital underwrite real estate deals, not to make them look good, but to see if they hold up under pressure. Because let's be real, the best time to find a bad deal is before you buy it. Can I get an amen? Even my throat cracks at that. Okay, so number one, guys, you have to stress test those deals, especially stress test debt service. When I underwrite a deal, I don't assume today's interest rates will stay the same, because for us, we keep our properties long-term, 20, 30 years. So what happens if the interest rate rises? I ask, what happens if rates go up another 100 to 200 basis points? If the numbers still work under high debt costs, great. If not, I move on. That's how I avoid getting into trouble if financing conditions tightens after closing. That leads me to number two, conservative vacancy assumptions. Next, I don't assume 100% vacancy all year round. People move. That's just how it is. Instead, I build in a vacancy rate of 8 to 10% when stress testing, even in strong rental markets like Edmonton or Calgary. Why? Because even great tenants move out. Life happens. If the deal only works with perfect occupancy, we don't want it. Third, slower rent growth and higher expenses. On the income side, I underwrite rent growth below market trends, not above. I often increase operating expenses from what the seller reports, because if a boiler goes out or a property tax hike comes through, you may need margin. It's better to be conservative and get upside later than to be aggressive and end up short. And those investor calls aren't fun. Fourth, reserves and CapEx planning. I always include capital reserves, even if the property looks turnkey. Things break, roof age, and tenants cause wear and tear. We build a budget to handle those things without dipping into investor returns. The truth is, I would rather walk away from 9 out of 10 deals than buy something based on overly optimistic assumptions. This is about long-term wealth and capital preservation, not gambling. And that's exactly what attracts sophisticated partners to work with us. Because discipline isn't flashy, but it builds trust. If you're someone who values conservative, grounded investment strategies, subscribe and follow along. I will be breaking down more of my multifamily playbook in this 30-day series, I want to say. And if you want deeper insights, join my private newsletter, link in the description. This video is for educational purposes only and not financial advice. See you guys at the next one. Bye.